Welcome to another MBS Highway live webinar. I'm excited to be your host along with Dan and Barry Habib. And today we have exceptional guests joining us to share their wealth of knowledge on financial growth and tax saving strategies. First, we have Michael Wall, a seasoned financial expert who has dedicated over 20 years to helping families enhance their wealth, minimize taxes, and live more purposefully. As a former CEO of multiple financial companies and a frequent commentator on CNBC, Fox, and Bloomberg, Michael brings a wealth of experience to the table. He's also the host of the Invest Well Show and the Michael Wall Show, and has coached over 120 advisors on building efficient practices. Michael's groundbreaking research into the Harvard and Yale endowment models led to the creation of the Efficient Portfolio, a trademark investment process that continues to benefit families across economic landscapes. Joining Michael is Stephen Snowden, who brings us passion for empowering families to grow their wealth and achieve financial freedom. With 5 years of experience in the industry, Steve has already made significant impact in helping affluent families reduce their tax burdens. A Penn State graduate with a focus on business management and entrepreneurship, Steve combines his knowledge of off-market opportunities and strong relationships with insights gained from mentorship by high-level business owners to deliver exceptional value to his clients. We also have their CPA, Nick Garassi, joining us, and today they are going to dive into strategies rooted in the IRS code that have been used by wealthy families for over 30 years to reduce their taxes. Get ready to learn how you can take advantage of these strategies to save in 2024 and beyond.
Hey, before we kick off, I just want to say thank you guys for joining us. I know Barry's going to be joining us in a second, but Barry, myself, Megan, and the whole team are excited to have you guys on because I can tell you from personal experience that I've had a chance and the pleasure of working with you guys. And besides being great guys, personally helped me out last year to mitigate some taxes. So I'm excited to hear about the new opportunities this year and maybe if some of our subscribers could also benefit.
Wonderful. Well, listen, first off, thanks for having us on, guys. Not only has it been a pleasure to, by the way, first off, great introduction, great energy there. Love that.
Emphatic.
And yeah, rocked it. Dan, appreciate you having us on, and Barry as well. Obviously, being able to help both you and your father has been a wonderful blessing in your lives personally, which has been just terrific. I mean, listen, being in business, and for those of you that are out there, obviously that are watching this, being in business, is not easy. I mean, it's tough. There's a lot of regulations. There's a lot of challenges. There's a lot of nuances in life and in business. And there's a lot of noise, quite honestly, that we have to navigate through. And so oftentimes what can happen, and Dan, you talked about helping you mitigate some taxes and some other things. A lot of times in life, we can find ourselves in a place where we spend so much time and energy and effort we're trying to be anyways, in our strength, which is where we help as many people as possible. We're making a lot of money along the way. I love what Zig Ziglar says. People that say they're not interested in money are going to lie about other things too, right? It's reasonably close to oxygen. However, we want to make sure that we maximize our time and we be efficient with it. And so oftentimes what happens is people spend the majority of their time looking for ways that they can help people and make more money, but oftentimes they don't spend a tremendous amount of time in areas where they're actually mitigating taxes. Their mindset is just, I'll just make more. And I think this is important to set up because there's a lot of folks. I know we did this webinar, Dan, I believe last year as we were helping your dad and yourself, but there's probably a lot of folks on here now that maybe we haven't connected with yet. So I want to kind of set this up real quick because I think this is so important. In my journey as an entrepreneur and really helping families with their wealth initially for years, protect, grow, and all of that along the way, I started saying, gosh, I'm starting to make more money around 2010, 2011. I was about 10 years into business at that time. And I'm like, what can I do? I had a pretty large CPA firm. They had about 27 CPAs. They had a bunch of other staff, supporting staff. And I'm just in a place where I'm really getting plain vanilla ideas. And I just said, how can I find strategy that can help me personally? It was really a selfish motive, I got to be honest, initially doing a lot of the research. And so I went out and I literally sought out strategy that gave me the ability to mitigate and reduce my own taxes along the way. And then the overflow of that is it just really overflowed to a lot of the families and clients that we've been able to serve on the journey. So I'm excited to share this. I'm excited for those of you out there that are watching this. If you don't know, we've been able to help last year almost $50 million of reduced taxes actual tax savings last year. This is a big, big number in 2023. So as you're watching this, you're able to join some of the top folks in the country, high income earners, multi-millions of dollars, and some of the strategies that they're utilizing. And obviously, we do a lot of talk on investments as well, and you can learn about that by going to the Invest Well show or whatever if you care to. But today we want to talk about the idea of tax mitigation. So Steve, that you see there, the pretty boy with the suit jacket, he's a great guy. I'm not going to get into it about college degrees and stuff because he's got one from Penn State, great school. And obviously Nick's joining us as well, actually running the tax side as far as running the soup to nuts returns. There's a team of 10 that actually support what he's doing, which is wonderful. 10 or 12. I don't know what it is now. Maybe it's 14, Nick. You can correct me when I'm wrong. 13. But we want to jump into some of the strategy. And before I jump to that, Dan, is there anything specific that you want to share that I haven't covered as of yet?
No, keep rolling, man.
All right, let's do it.
Awesome. I'm going to get this.
Grab your water and let's go. So Steve, what I want to do is I want to have you highlight maybe the first, let's go ahead and share our screen. Let's get that rolling. 3, 2, 1, boom.
Oh, is it up there? I'm not seeing it.
I see a black.
Yeah.
I see a black screen, which is wonderful. We all love black, but let's look at what we're looking at here.
There we go.
Try to get, there we go.
Awesome.
That's exciting. All right. So Wall Private Wealth, unlocking tax savings, proven IRS strategies for 2024. I think it's important for you to know that a lot of things that we're going to discuss here, okay, I want you to understand this. I've spoken to a bunch of CPAs in the country. In fact, that's one of the ways that I met Nick a couple years ago. I was actually speaking to about 200 CPAs in Dallas, kind of giving advanced tax strategy and coaching to them. I'm a big believer when you look at life, a lot of people don't know what they want because they don't know what's available. So I think it's important to set this up before we jump into some of the things we're going to discuss here. Listen, a lot of the folks that you interact with from a CPA perspective are wonderful people. They really are. But unfortunately, they're historians. And by historians, what I mean is they look at last year and they kind of say, okay, how much did you make? How much did you give? What charities, what nonprofits, what organizations were you involved in? And so now this is what you kind of give, and you have to pay or you get back. And oftentimes this strategy is going to be maybe plain vanilla. Buy another car, buy another building, maybe add to your SEP account, if you will, some kind of basic ideas. And it's not that they're bad people. What you have to understand with most CPAs that are out there, and we've shared this with them, because some are very proactive, and I love that. But most CPAs don't often think like entrepreneurs. They just don't. And that's where the divide comes. And Dan and Barry, we've talked about that along the way, is a lot of CPAs don't think like entrepreneurs. And Barry, would you mind taking a minute just from your perspective and talk to that?
So I think you're exactly right, because I've experienced it my whole life. I love my accountant, and most of the time they are, just as you said, historians. And that's the way it is. Okay, you got a K1 from this, you got, my returns can be complicated, but that's what they do. And I think since I've been working with you, and the reason why we brought you and Steve on last year, we were able to introduce a lot of concepts to my account. And look, and I think Dan can speak to this firsthand too. You guys literally saved me. You literally saved me $200,000 in tax. And I think Dan saved a huge amount of money in tax just because of the advice that you put us in. And I know a lot of our members that were on the call last year, they all saved a shit ton of money. And the reason why we wanted you guys and needed you guys back is because we said, let's do two things. Let's not cut it so close to the end of the year. Number one, let's make it, we have more time. And number two, have a broader audience be able to take advantage of this and save some money.
Yeah, no, I love that. And again, so I just want the audience and those that are listening and dialing in here to know, again, this is not a cut to anyone. A lot of people have experts, quote unquote, in their life. But again, it goes back to this thought, which I'll rest on a lot. And that is, a lot of people don't know what they want because they don't know what's available. So our job is to really help families and folks find out what's available. These strategies have been around for a long, long time. And so, and again, anyways, when you look at your CPA, there may be some CPAs that you're working with that may say, I'm not sure, I don't know. And that's where you got to have a deeper conversation. We're going to give you the opportunity to learn how to do that later. But let's jump in, Steve. Why don't we go, and I'll give a high level, and then I want you to talk about some of the things. Let's go to the next slide here. We're talking about highlighted strategies. The first one we're talking about is fee simple donations using section 170 A and H of the IRS code. Then we're going to talk about intangible drilling cost deductions via oil and gas utilizing section 276(3) in the IRS code. And then we're going to talk about advanced depreciation and cost seg through hotels utilizing section 1245 and 1250 of the code. Now, I want you to know that there's almost 80,000 pages in the IRS code. And so one of the things that you got to understand is there's so much information in there that a lot of CPAs, quite honestly, don't utilize. And it's not because they don't necessarily want to. It's because they don't have time to. When they're doing thousands and thousands and thousands of returns every year, they're in a situation where they just don't have time to get granular. They're in a space where they're just kind of doing returns. So let's jump to the first idea, which is fee simple. Steve, if we can go to the next slide. And fee simple offering. And Steve, I want you to take a minute. And I know you've been dealing with a lot of folks directly when they're calling in about this. You're kind of the lead guy when it comes to these types of things. So why don't you kind of give an overview of a little bit about these offerings? Obviously, this type of strategy has been around for a long time, since the 80s. It's been acted by Congress. Jump into some of the high levels on this, if you would.
Yeah, no, of course. And it's been a pleasure working with so many of you guys in the community. I really enjoyed it last year, and I've really enjoyed working with a lot of you guys this year as well, as we begin rolling some of these offerings out this year. So in the fee simple space, really what that is it's taking advantage of section 170 of the IRS code. What section 170 is it's very simple, taking the highest and the best use value of a piece of property. In the past, since these have been enacted in 1980, you can do that in many different ways. It's been done in solar, it's been done in mining, minerals, lumber, cattle, many different ways. It's about taking a piece of property, find the highest and the best use value of it to do a couple different things. Either use it for an investment, use it and donate that to a qualified nonprofit to get a tax deduction, which is what we're talking about today, and a couple other different ideas. Now, typically on the fee simple offering, so us taking the highest and the best use value, usually that's a 5 times multiple on the base of the investment. So the amount that you would be placing in is usually a 5 times multiple. I'll let Michael get into some of the more details there. But ultimately, how we're able to take the deduction through the fee simple is by donating the highest and the best use value of that property to a qualified nonprofit. And that's done through an extensive research cycle. So for example, last year, a lot of you participated in the offering. It was in northern Alabama, Chambers County. And on that piece of property, it on paper was worth roughly $10 million. So we brought in 2 of the largest mining companies in the country because it had great mining qualities. We could have used that to build bridges, highways, and other infrastructure. So those 2 mining companies came in and they looked at the quality of the rock, what was the level of the rock, what could we do at the highest and the best use value. And some of that cycle is there on the right side, finding the right property, survey and title research, doing the geology, engineering, mining, and feasibility reports, doing the market valuation research, and a couple of the other steps there. And again, with the offering that we had last year, so the property on paper was worth 10, and last year the highest and the best use value was 55 million. So there was a 5.5 multiple last year. That's higher than usual, but again, that's one of the opportunities that a lot of the group took advantage of last year.
Yeah, and Steve, I'm going to let you talk about what it's going to look like actual tax savings next slide, but don't go there just yet. One of the things that I want you guys to know as you're listening to this is we're going to talk a little bit about 30,000 foot views. Obviously, whether or not this is appropriate for you specifically, you'll have an opportunity to kind of find that out when we're done with this. But I want you to know this. When you take a look at these, just like anything else, there's good and bad of everything. One of the reasons that you're involved with MBS Highways, they've done a great job of providing valuable, practical, applicable information that has actually helped you become more of an authority in your space. And so just like anything else on the tax side, on the investment side, there's good and bad of everything. One of the things that we get paid to do in a lot of ways is do a lot of research to find the good and the bad so we can offer the cream to the families that we're working with. You're going to go out there and you'll find, whether it be conservation easements or fee simples or other things, you can research till you're blue in the face and find things that have been bad. So you need to know that in advance. Just like not all doctors are great, but some of them are exceptional. You have to make sure that you know what to look for when you're looking at researching these deals. That's so important. The other thing that I got to tell you is when you take a look at these, essentially what Steve said to kind of bring this into kind of color for you, hopefully, if you went and looked at a piece of property, right, and that property is worth $10 million, but if we actually say, okay, what is the highest and best use? Hi, Boo. What is the highest and best use of this property? And we can maximize it for the tax savings. In Section 170, it allows us to utilize part of the IRS code. It allows us to utilize the highest and best use value of that property. So if we were to actually take this property and we say, let's say we were going to mine it instead of just buying the property. We said we're going to bring mining companies, we're going to mine it. We have all the research and development done to say this is what it would look like, all the core testing and samples and studies to know what is actually under the ground. And if we were to mine this project and mine this property, here's what the value would be to the market over roughly 15 years of selling the aggregate and the rock underground. Well, we know what that valuation is going to be. So now what the IRS does is they say, hey, listen, because we have a high focus on preserving ground and property for the birds and the bees and the flowers and the trees, along the way, because we have a high focus on that, we're going to give you incentive. We're going to give you a tax credit for actually, or a tax benefit for actually preserving ground that you could have mined and tore up, if you will. But what we're going to do is we're going to give you the ability to have a tax deduction based on the highest and best use value of that property. The highest and best use value in this scenario of that property would be to actually go in and dig and mine and pull the rock out of the ground. But because we're all electing to not do that, right? You get to vote and everyone elects to not do that. Then now we get to capture the highest and best use value. And that's where that 5 times multiple comes from. It's so powerful. And Steve's going to talk to you real quick, next slide, on what that actually looks like filtered down through on your income. Go ahead, Steve.
Yeah, so what this actually looks like when we break it down. So whenever we elect, the investors elect to donate that property to a qualified nonprofit, how does it actually work? So it flows through to the investors on form 8283, which is a non-cash charitable deduction form. So let's say you donated a piece of property to American Red Cross. That would be an 8283 deduction, a non-cash charitable deduction. So through that, we're able to do an applied reduction of 30%. So in the example here, if you make $1 million, 30% of $1 million is 300,000. So through this investment type, we could deduct up to $300,000 of our income. So whenever we're talking about this year's multiple, which we'll get into some of the details of this year's deal, it is a 5 times multiple this year, roughly. So if somebody were to be making $1 million in income, we could deduct 30% of that. So we would have a $300,000 applied reduction. As you can see on the formula here, we have 300,000 divided by 5. So 300,000 being the applied reduction eligibility, divided by the 5, which is the multiple that we would get on the investment that we'd make. So when we do 300,000 divided by 5, that gives us 60,000. So we would have to make a $60,000 investment at 5 times multiple to get a $300,000 applied reduction. So what does this actually look like from the tax savings perspective? So I use New York state tax here, for example. So we take the $300,000 tax deduction that we're getting and we multiply that by your tax brackets. So federal would be 37 in that scenario. And then the New York state tax would be 11.7%. So that's going to come out to roughly 49% that you're going to save on that $300,000 because you would have been paying that money in taxes to the federal government and the New York state tax. So ultimately, when we take that 300,000, we multiply it by those 2 tax brackets, your tax savings in that scenario would be $146,100. But we would have to invest $60,000 to get it. So your total ROI would be roughly $86,100 that you would get. And remember, this is one thing Michael and I tell clients all the time. You are either paying that money in taxes or you are electing to invest in this to reduce your AGI ultimately.
Yeah, and Steve, first off, great analogy and overview of that. Thank you for that. This is really the beautiful thing about this process, guys, is in my mindset that if we can't do a deal like this that gives us the opportunity to think of it this way, we'll call it 100% ROI on our money, roughly, as far as what we put in tax-wise, then we really don't want to be involved. And in this scenario, again, simply put, you're reverse engineering your investment. So if you're making $1 million a year, now a couple of the strategies years ago were 50% of deductible applied reduction, so to speak. So if you made $1 million, you could deduct 500,000. Those still exist for family type plans. So if you're kind of one of those folks that has some wealth in your family, that's something we might want to talk about. It's a little bit of a deeper, more individualized process. You can carry the deduction forward for 15 years of anything that you don't use today. And if you think about the fact that whether or not taxes in the future are going to go down or up. They're probably going to go up at some way, shape, or form. So if you're a wealthier family, that's something that we could design specifically just for you. It's literally in a place where it's not a listed transaction. It's a K1 loss. There's a lot of things that are beneficial there. But for everyone that's just basically making a nice income, you can reverse engineer your number. If you're making $1 million a year, there's the math. And if you're not in New York, maybe you're in Florida, obviously the math is a little bit different. Maybe you're making $2 million a year, $3 million a year, $5 million a year, 10, whatever the number is, you reverse engineer that number, and then you're in a situation where you can find out, okay, this is roughly what my savings would be. It's really a beautiful thing. The other thing that's nice.
A couple of things I just want to jump in. So
please, Barry, go for it.
Even if your income is less than that, it could still make a lot of sense. So it doesn't have to be $1 million a year. But also wanted to point out that, as you're showing here, you're investing 60, you're getting 146. So minus the 60, like Steve said, it's an $86,000 profit that you're making. If you think about an investment, you're making an 86, that you're getting a 146 return on 60. So it's very, very, very compelling. And considering the time, it's not you got to wait 10 years to get it.
Right.
Depending on when you file your taxes. If you do it sometime, let's just say you do this in September, October, by April, if you're filing your taxes, I mean, what are we talking about? 6-7 months to make, whatever the numbers come out, 135% return on your money. It's sensational. So that's why we're excited about this. The other thing that I found very important to talk about here is when you're faced with the fact of thinking about, okay, somebody just jogged my thought process on this. It was Matthew Harris who put there, I could have really used this strategy in 2021. Yes, of course, there was a lot more money made, and you're right. But team, I think that we need to look at this now, because I think we're in the beginning of a refi boom. I think the refi boom is here. So I think your income is going to go up significantly. You might make more money than you think you are on pace to make by the end of this year, certainly into next year. And that's what I wanted to talk with you about, because if somebody is thinking, guys, that, hey, I might not hit those this year, maybe I might have too much deduction and not enough income. In other words, let's use this example. Somebody says, hey, I'm making $400,000. If I did the 60,000, it gives me a limited deduction because I could only take 30% of the 400. But what I want to make sure they understand is that it does roll over into next year where you get that benefit. I thought that was such an important thing for us to understand, that you're going to make more money at the end of this year. You're going to make a lot more money next year. And I think that people should know that you could use it into next. It doesn't expire. It's not like, oh, I got to use it this year. And therefore, so maybe you could chat with that.
Yeah. No, Barry, that's a wonderful point, and thank you for bringing that up, because it's very, very important. One of the here's what we know. A lot of people say, well, what type of planning do you think we should do 3 years from now? Well, I don't know. The laws and the rules are going to be different 3 years from now. Like, we just don't know. But what we do know is the what's available now. And because these are available now, Barry, to your point, which is a wonderful example, this is literally the fee simples, the way they operate. Okay. You're in a place where this can carry forward 5 years. So you're in a place where you're literally buying a future tax deduction, which is a wonderful thing, or buying something that can apply this year. And to your point, no, you don't need to make $1 million a year, because the math is pretty simple. Even if you make 500,000 or 600,000, go ahead, Barry.
If I may, as you guys know, I purposely invested more than I could take the deduction for.
Yeah.
Because what I contemplated was that this is an election year and anything could happen.
Yes.
And next year, I'm not sure what might change from a tax perspective if something like this would be available to go in. But if I were already in it, I'm already in grandfathered and have the 5-year rollover. That. So that's why it was important to me to actually go more than what I could actually take so I could carry it forward. But somebody said something I want you to address, because we all had this question. I had this question. I grilled you guys on it when we first started, right? With the CPA saying that, well, would this cause an audit? Would this? So could talk about that, because I was very satisfied after you guys spoke. And I know, Dan, you had the same concerns, right?
Same issue. My accountant was a little iffy on it. And after having a deeper conversation, sending him all the provided documentation that you guys gave, he was completely singing a different tune.
Yeah, same with mine. They were gung-ho.
Yeah. listen, so that's a great point. And by the way, that's not going to be uncommon. So expect that. If you go to your CPA, expect them to say, wait a minute, time out. No, these are bad. I did some research and I saw these articles. I mean, Nick's on here and you'll be able to chat with him later as well. I mean, he's very, very, he's, for lack of a better word, I'm going to use the word anal than I am. I mean, that's a good thing, right? As far as getting into the details. But what I will tell you is my experience has been this. I've been utilizing these types of structures basically since 2011, 2012. I have personally, I can only speak to me personally, I have personally never been involved with a client themselves having an audit in relation to this. Now, the deal itself oftentimes can get audited, and that's what they can highlight. But after 2016, the burden of you, the client, let's say Barry or Dan, having to prove this value has gone away. So that's changed after 2016 legislation. The other thing that I'll tell you is very interesting. If you know this name, Chuck Rettig. So Chuck Rettig is the previous commissioner of the IRS. You guys have all heard of the IRS before, right? So Chuck is the previous commissioner of the IRS. Go look it up. He actually works now. He's been obtained and attained to work for a firm by the name of Chamberlain, which is a law firm, which is now on the side of defense of these types of deals against the IRS. I think it's very interesting. Another name to write down is Travis Graves, a good friend of mine. Travis is actually a District 13 Trump court-appointed judge in D.C. That's a good friend of mine. He's a judge, tax court judge, and we've had lots of conversations about these types of things. The goal of the IRS in a lot of ways is to write articles and reports to scare CPAs, to allow them to not do what is actually in the code for their clients. Because what's the ultimate goal of the IRS is to get more tax revenue. So if you really understand that and you don't just take it at face value and say, okay, let's actually dive into the reality of the fact that these types of opportunities have been enacted by law for a long time, since the 80s. That's number one. So this isn't I was talking with somebody that had a tax strategy that's been around for about 6 years. It was a great tax strategy. Nick is shaking his head there because we had a conversation, and our CPA. And the idea is like, no, I'm not interested in using that. Why? Because there's not enough tax court kind of predominance or study, if you will. In other words, it hasn't been in court long enough to really know how they're going to roll. That's one of the benefits of a lot of these strategies. We know that if they're designed correctly, there's been so much tax court real world, we'll call it practicality in relation to these deals, that we know that if they're designed correctly, done correctly, and have the right type of evaluations, we're going to be in a place where there's a very, 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 very high probability that are going to be just fine. God forbid anything like that occurs.
Let me just
client themselves is going to be good. Go ahead, Barry.
Let me add a couple of things because I see some questions coming in. So a couple of things. Number one, Tim, I suspect the total tax rate of 20% between federal and state is where the tax savings equal. So if your tax rate's 20%, remember, what you have to look at is what is your marginal tax rate, not what your average blended tax rate is, because you pay no tax initially. That, so you go from 0 to 15 to 20, so you go through that. But what the benefit of this is, it's coming off of the top end, because that's what you're paying the aggregate dollars on, is at the top end. It's not your blended tax rate. And of course, you have to do the math to see if it makes sense for you. That's clearly the case. If you're in a tax bracket, hypothetically, where your top tax bracket, you're paying 20%, you're probably earning less than $100,000 a year. This is not the type of investment for you. You have to be earning more than that in order to take advantage of it. Somebody says, is 60K the minimum investment? Linda, no, please remember that he used the 60K as a reverse engineering. He took an example of $1 million income and said, okay, the max you could deduct in 1 year is 30%. So that means 30% is 300,000. And then this is a 5-to-1 multiple. So you have to divide it by 5. So that's a $60,000 investment, gets you $300,000 deduction. So that's the way. So if you're making 400,000, okay, you take it as 120 would be 30% of that. Right. And then you take 120 and you divide 120 by 5, and it's $24,000 would be the investment. Do you follow?
Now, is there a minimum investment though, team, where if in Barry's scenario, if there is a higher minimum, you can always roll that benefit over to the next year?
Yeah, I mean, typically most of these deals, and the one specifically that we utilize that's integrated in is about $50,000. But we have some wiggle room there, obviously, that we can wiggle from time to time if necessary. So it doesn't necessarily be half to that, but we try and kind of stick to that if we can. I want to touch on one thing, though, Barry, that you talked about as far as your average return and things like that, because this is so important. And Nick, I'm going to bring you in on this real quick, if you don't mind, because what's so interesting is how the deduction of this actually applies when you look at ordinary income, as well as cap gains, as well as a variety of other things. And we were looking at a client. In fact, there's a particular client in Texas that we saved him, I think, almost $840,000 this year in taxes with some of the things that he had going on. Nick, do you want to talk about how this flows through real quick on the return, high level down? I think it's so important to touch on this.
Absolutely. So essentially, you as the investor are a limited partner in a partnership where the donation is actually taking place. Transfer, as Steve said, transferred to a qualified nonprofit, and the donation itself, the deduction that you're receiving, is passed along to your individual tax return on a K-1. Just like if you have a corporation or a partnership and the income passes through to you, the deduction will pass through to you, the investor, from the donating entity. As far as how the deduction is applied, we tested this, ran through this a couple times with tax planning. The deduction is actually first applied to your highest taxed income first. So if you made $800,000 as a W-2 employee and you had an additional $1 million in long-term capital gains, your AGI is 1.8 million. So you're eligible to offset up to 30% of that. The power of this type of strategy, though, is the deduction that you receive will first be applied to your high tax income, and then the lower tax things like long-term capital gains or other more tax advantageous types of income.
Which is so powerful, and thank you for sharing that, Nick, because when you look at your effective tax rate, that actually blows us out of the water a little bit in relation to how this works, which is really a beautiful thing. Here's what I want to do, though, just for a sense of time, and those that are on the call. We have two other quick thoughts that we want to jump into, Barry, if it's okay with you, unless you got something else you want to jump into. I thought we'd kind of keep rolling. Yeah. By the way, for those of you that have questions, this is the time we're going to give you the opportunity at the end. You can connect with us. You'll be talking to Steve specifically initially. He'll walk you through a lot of the details, really just to determine whether or not it's appropriate. As Barry said, this is an election year. It's a great opportunity and a great time to kind of buy future tax savings as well. That's kind of how we're looking at this, future thinking, unless you think you're going to go out of business next year. I don't think you will. You will and are. So that's one of the things that we want to be thinking about as you're thinking about growth in the future. Remember, this deduction specifically is an investment for the purposes solely, primarily of a tax deduction and tax savings. Next things that we're going to talk about have tax savings benefits, and we're just going to touch briefly on them. We can spend more time directly with them, just again for the essence of time. But the next two things that we're going to discuss actually have an investment component to it as well. So we want to jump to that. Let's jump to the next slide, Steve, if you don't mind. And this is getting into potential tax benefits for investing into oil and gas. And there's a lot of different things on the screen here. You can read it if you want. I'm not going to read all the verbiage, but the big picture of this is something that I've been involved in a long time. And you may think to yourself, well, the EV market's been hot. Has there been really benefit, or is there still a need for oil production in the country? The answer is there is. In fact, it's actually continued to grow every single year, regardless of what's happened. And so one of the benefits of some of these things, in fact, we just saw this last month, 2-3 months, a lot of clients and families that are invested in some of the oil deals that we're involved in have gotten anywhere between 3 to 4% for the month in distribution back from the wells. So they're making really, really strong distributions from these investments. But one of the nice things about these is they don't work on a multiple. We just have the ability to deduct what's called intangible drilling IDCs, intangible drilling costs. You can see on the first blue box on the left side, roughly 80 to 85% of the investment has the availability of deduction year one. And then we also have the availability to deduct tangible drilling costs in addition. Steve, why don't you take a minute and kind of walk through this for a client as an example? Let's say somebody now from an investment perspective, what's nice is these actually fall into or land into two different categories on the tax space. So the fee simple donation landed in the charitable donation side of life. This falls in a different category, so they can kind of complement one another, which is nice. The goal is to kind of be in a place where we can legally, morally, and ethically disinherit the IRS. So if you're in a place where you have cash or investments that are maybe following the yo-yo of the market, now we can be in a place where we can say, hey, okay, let's invest in a deal that from a realistic perspective, the goal of this investment is to do it about a 2.5 times multiple over about a 4 to 5 year period of time. So you can do the math on that. If you invest $500,000, 2.5 times is the goal, or 100 or a million or whatever the number is, in 5 years, that's the goal as far as return on investment. But in addition to that, we're going to get some tax savings along the way that complements the fee simple structure. So Steve, just talk about how that deduction or a tax benefit works for this.
Yeah, no, happy to. And one of the things that Michael shares about oil, a lot of people have experience in oil. A lot of the times it may have been in one well or a family well, or you weren't diversified, or it was wildcatting. You were going out there and trying to find oil. A lot of the times whenever we invest in oil, we're in a place where we're diversified. This offering this year is diversified in 10 different wells. It's actually in the Barnett Shale combo. And the way we like to look at it is there's really 3 different ways we get return. So for example, last year, the 10 wells that we had, if you were to invest $100,000, 84% of that investment came through an intangible drilling costs. So as you guys can see there on the screen, that's essentially the labor and wages, the fuels, the repairs, the supplies, everything that wasn't used for the end result of the oil. And that came through to clients on a K1 loss. So if you're, for example, invested $100,000, you would have gotten the $84,000 tax deduction for 2023. It'll be similar this year for 2024. And then the second way we get return, like Michael said, is when we begin drilling, fracking, pulling the resources out of the wells, we get a distribution. Now that distribution is going to fluctuate with the price of oil. Right now, the price of oil is really high. It's been really strong. And we're in a place where we're seeing on average on an annual basis, roughly 13 to 17% in distributions. And then ultimately, after 36 to roughly 48 months, as we fracture a little bit more horizontal, a little bit more vertical, we then exit those wells to market to a bigger company with some meat on the bone. So a lot of the times the way we look at it is the tax savings are great, especially in a high income market, and significantly decreases the risk of the investment with the tax savings that we get.
Yeah. So the benefit of this, guys, is it's not just the tax benefit. There's actually an investment play as well, which is great. The tax benefit is not as strong, obviously, as the fee simple deal, but that's only focused primarily on tax benefit. This is, you get tax benefit, but we're looking at it as an investment play as well. And again, it complements what we're doing there. Anything else, Nick, do you want to share on that you feel is important that we missed, just high level?
No, I think you covered it soup to nuts here. It's a good strategy to layer on with some of the other things we're talking about today, but yeah.
The other thing I want you guys to know is Nick chimes in from time to time here. Again, he's been in a he's literally a CPA, the filing return. So this is someone not just on the investment side. He's filing returns. He's been in the game 10, 12 years. His father was in the game 30 years before him. So he's been around a lot of stuff. In fact, we've even experienced some pushback from him as we collaborated and connected, which is a wonderful thing, I think, along the way. All right, let's move to the last thing here, and then we'll give you the opportunity. That way you can go have your cup of coffee and all that kind of stuff. But give you opportunity to connect with us should you want. So the third opportunity is the idea, and there's others, by the way, there's other strategy that we can do. We, on the investment side, we're working with, again, wealthier families. Tax side, we're working with folks that are coming in that are kind of growing, developing, and oftentimes have some nice income. But as another investment / tax benefit, and there's some variables and details here, but again, high level, we're in a situation where investing in hotels, I'm involved in an organization that's been investing in hotels, primarily Hiltons and Marriotts. They've done a great job for about 35 years. It's actually an Indian family. They have direct access to a lot of different things, kind of a preferred vendor for Marriott and Hilton. And their IRRs have just been strong. Total IRRs of mid to high 20s annually, and cash on cash return annually of about 12 to 18 to 20% a year, depending on the projects, with a tax deduction component. So I'm just going to talk high level here. Tax deductibility, whether it be through tax benefits and cost seg, if a property is purchased and refurbed, and then the flag is changed. Let's say we find or identify a project that, let's say, is a Holiday Inn that we find would be a great a flag as a particular type of a Marriott within the Marriott family, and we buy that property, and then we convert it to a Marriott brand. There's several different ways that we can take tax benefit in that process: advanced depreciation, cost seg. Oftentimes that can flow through the investor, again, depending on the situation, as anywhere between 1 to 1.4 times deductibility. So if somebody were to invest a couple hundred, $200,000, $300,000 over a year to year and a half, they can oftentimes see a 1 to 1.4 times of their investment as far as deduction on what they invested, and then have the ability, again, these are about 4 to 6 years in nature. And the goal here, again, is about 2 to 2.5 times roughly as far as total return back, bringing the capital back to you. So again, we want to bring in a diversified kind of smattering of opportunities, if you will. These are just a couple, 2, 3 opportunities. We spent most of the time on the fee simple. My highest encouragement to you is really to say what is appropriate, what is right. Well, you might be in a situation where you're just a higher income earner. You're making a couple $100,000 or more a year, and you're like, I got some questions about my story. Then maybe fee simple is best. Maybe you're in a place where you got some great investments as well, and you want to kind of diversify off market. You want to do some other things. We've got a lot of other things that we can bring to the table there as well to kind of assist and help if it's appropriate. I will say that the other thing that you need to know, and Steve, if you want to move to the next slide, the other thing that you need to know in relation to the deals specifically, be simple as well as other deals, they do close. So that's one of the reasons, as Barry mentioned, we wanted to bring this to the table a little bit earlier this year. This isn't just an evergreen deal that's open forever. It is open now. We're about halfway through. My best guess is probably that this deal, the fee simple specifically anyways, will probably close in the next month and a half or so. That's my guess. It could take a little longer than that, but that's roughly what we're probably looking at. So we wanted to give you the opportunity in the next month and a half, 2 months, to have the ability to be in a place where you can participate in something like this, as well as maybe some other strategies that may be beneficial or helpful along the way. What we've put on the screen there is a number, 561-815-1737. That's going to go directly to Steve. Again, he's the pretty guy with the suit jacket. If you got questions about whether or not this is appropriate, as you can imagine, we're dealing with a lot of folks in this time, in this season. So please be clear with us. So that way we can be clear back with you and really not waste time on anybody's aspect. Just share with us your name, the best time to chat, an estimated income range. And that way, at least we can start with, and Steve can start with an idea of how he may want to approach the conversation. If you got questions about investment in addition, you may want to add that. Hey, I roughly have X as far as dollars invested. I got some questions about that as well. Happy to do that. Barry and Dan, I don't know if you guys are playing ping pong or what you're doing. I'm just kidding. Is there anything else that you guys want to talk about before we kind of land the plane here?
Well, first off, thank you guys for coming on. You know, the fee simple seems like a pretty clear-cut strategy, one that I'll definitely be taking advantage of. Once again, real quick on the other 2 investment ideas that you had mentioned that also have some tax benefit in there as well. What can you expect is like a yield on those or return on investment?
Yeah, so I mean, there's a general rule of thumb, both of those. I'll just put them in the same category, Dan. The goal is to be about a 2.5 times our money in 4 to 5 years.
Got it.
So you get the tax component, wonderful. But not counting if we counted the tax component, it would be stronger than obviously that as a return. But we're not counting the tax component. Just on the invested amount, the focus of what we've seen in the past and what we've seen in the future, as far as availability and what's there, is typically about a 2.5x on your investment in 5 years. That's the goal.
Got it. And for those, is it a similar minimum?
Those minimums can be different. You know, the hotel deal could be a couple $100,000. The oil and gas, I believe, is resting at about 100. Because it's more of an investment component per se. And typically, you know, we're really, be honest with you, because of you guys, you know, as you guys know, our investment minimum is $3 million. Our family office division starts at $25 million. And then we have a pro athlete division. But because, you know, Barry, you and Dan have been just so wonderful to us over the years, we wanted to say, hey, you know what? If there's folks out there that we can help, we're going to break our minimum. We really don't do that. If you watch me on social, if you watch me on Insta, if you watch me on different things, it's really a rare thing. But as a general rule, those investments in general, Dan, do have a little bit higher of a number that's needed to kind of make the minimum.
Awesome.
Good question, though. Barry, anything that you want to share before we land the plane?
No, I was looking at, you know, we answered the questions that I saw come across. I asked you about the ones that came over. There might have been one other question that I thought maybe we wanted to. No, I think we got all of them. I do. I think we got all of them. I'm just
wonderful.
Tim had said, is this like donating a beater car worth 500 but claiming it's worth 20,000? It's not quite that. You know, this is a real appraisal. This is real, you know, it's not claiming it. It's what the highest and best use value is determined to be based on an appraisal. And it's finding these type of investments, why they're not so widespread, but they
Highly
are
researched. Yeah.
highly researched. This is really valuable stuff, guys. I wouldn't bring it to you.
Yeah, no, this is,
I was
and
in it.
to that point, Barry, I just want to touch on that. Every single deal on the fee simple side has 2 appraisals. And one of the things that we've learned over the years is, these appraisals are done by either, whether it be a Novogradac or, which is, by the way, who the IRS goes to get their information when they want to evaluate. So these are the kind of people that we're using. This isn't name it and claim it, fly by night. No, this is literally, there's been core studies and testings and things. We know what's in the ground roughly. And we know that if we brought it out over a 15-year period of time and we sold it as rock to the marketplace, we know what we would get. We know what the market price is. We're not assuming a future market price. We're signing an LOI potentially that we have actually as well with mining companies saying, this is what we would be able to get for a 15-year term based on current pricing, with maybe a small future adjustment, but typically it's based on current price because we want to be uber conservative. And then when we do the deal, if the valuation comes back at 75 million or 80 million for this project, we're going to say, you know what, we're going to take an abundance of caution and actually use a valuation of maybe 60 million or 65 million. So we're going to even go 10 or 15 million lower sometimes than what's actually there. So no, this is as real as the computer that you're looking at right now on your screen.
Awesome. Well, thank you guys. This was great having you as usual. Thanks everyone for being on.
Thank
Yes,
you guys.
thanks everyone. If you have further questions, do not hesitate to text that number and you will be getting a recording shortly.
Michael, Steve, Nick, thank you guys. Great to see you.
Thank you, guys.
Absolutely.
Appreciate it,
Dan,
guys.
thanks for everything. See everybody later. Hope you have a blessed and
Bye.
wonderful day.